Consumer is going to hell. Now, how do we stack this up with the potential for massive disinflation, the lack of PP, the lack of pricing power, consumers rushing back to get jobs, whether it's at Lyft, at Chipotle, or Starbucks? And yeah, I'm hoping you leave a comment correcting my pronunciation, because we up the engagement anytime we talk about PP. But we've got to talk about the reality, which is a massive problem facing the consumer and what could potentially drag S&P 500 earnings down in the toilet with it. And that, after all, is the second phase of a recession. First, you get multiple compression, then you get EPS fall. Earnings per share falling happens when the consumer spends less money. And what did we just find out from the consumer? Well, total credit increased $11.6 billion in January from the prior month. This is the smallest increase in 2 years, well below estimates. And it goes to show that even though in prior months consumers have been supporting their spending with credit cards, we have had a massive decline of spending in January. It's almost like in January, consumers finally have hit a wall, that potentially consumers have been supporting their lifestyle, much like American Express warns that the high-income consumers are supporting their lifestyles through this recession by spending more on credit cards and taking out more small business loans. We are seeing what? More spending going through December, but what's happening in January? Oh, consumers potentially finally hitting the wall as they have maxed out their ability to borrow on either credit cards or buy now, pay later. Now, PayPal is bragging about buy now, pay later rising in the fourth quarter, but the forecast's a little bit more murky. But where we could really see where the forecasts are murky are at Affirm. Consider, folks, that Affirm is a company that bragged for months that they would do well in a recession. Affirm is a company that I have since the day I first looked at Affirm, said, do not touch Affirm with a 10-foot pole if you go into a recession. I've said that a million times, and I will stand by it. Affirm has unfortunately changed their tune on the consumer, though. Not only are they now talking about economic uncertainty and no longer talking about how great it is that Affirm offers buy now, pay later services in a recession, but all of a sudden, when we actually look at their earnings, we see a giant L. It is a bad L. Now, we talked about some of this in the course member live stream yesterday because that's what we do. We talk fundamentals and business and Q&A in our course member live streams every day the market is open. Link down below for those. But what did we learn from Affirm? We learned that their revenue increased 10.6%. But while their revenue increased 10.6%, their gross payment volume increased 27%. What does that tell us? It tells us they have a lack of pricing power. Now, part of that lack of pricing power could be because Amazon now represents 20% of Affirm's sales. And we've all been worried that Amazon would end up compressing Affirm's margins, basically making Affirm take all the risk without actually getting a lot of the dough, a lot of the profit. And that appears to be exactly what's happening. Even though gross payments are up 27%, revenue for Affirm is only up 10%. That's bad. That means a third of their increase in payment volume went to revenue, which means they're basically having to discount how much they're able to charge to make these loans to convince people to actually make them. That is a lack of PP. In addition to having a lack of PP, they are now having gross PP and dirty PP, because they have increased their allowance for credit losses twofold. So in other words, their revenue went up 10% and their credit losses doubled. Think about that for a moment. Revenue up 10%, loss projections doubling. That's what happens in a recession. You have the riskiest form of lending. Why would you touch Affirm with a 10-foot pole? I don't know. Maybe to speculate in the short term that rising tides lift all ships. And sure, the ship of, it's kind of like the ark that carries all the animals, right? Even unprofitable companies can lift up as the sea goes up, but that doesn't make it a quality ship. Anyway, this was a big red flag. And then their earnings call, they actually reiterated that they are lacking pricing power. They are vacating a portion of their San Francisco office. They're letting 19% of their staff go. And what else are you seeing? Well, you're not just seeing weakness at Affirm. Dell is laying off 5% of its workforce, lowest headcount in 6 years, as they continue to, quote, experience market conditions that erode with an uncertain future. And 55% of Dell's revenue comes from PCs, and we all know the PC market has been getting whacked. This comes at the same time as we know that 64% of individuals are living paycheck to paycheck. And now we've had a 9 percentage point increase in those making over $100,000 living paycheck to paycheck. Yes, even people making over 6 figures are living paycheck to paycheck much more today than last year. Appliance demand is weakening even more substantially and is expected to weaken through 2025, which is absolutely insane, and this increases fears that maybe we will end up hitting a recessionary environment. You're also seeing a massive inventory overhang. Under Armour is cutting prices like crazy to get their goods sold, which is actually putting pressures on companies like Lululemon, who basically lost their PP. Lululemon bragged that one of the reasons they didn't have to cut prices was because they didn't raise prices as much as the competitors, which is insane because that's your first red flag that they don't have PP anymore, pricing power, right? They didn't raise prices like the competitors did. But then guess what's happening now? Now, even though the competitors raised prices and Lulu didn't raise prices, and Lulu's like, see, we won't have to cut prices because we didn't raise prices. Everybody else is cutting prices. Under Armour is slashing prices. What's happening at Lulu now? Oh no, Lulu is also discounting. Oh dear Lord. And they're discounting from a lower base. Consumers have hit a wall, and this is bad news. This is exactly why we are seeing a slowdown in spend. Look at, for example, Newell Brands. Newell Brands just reported. Newell Brands, you don't have to even look at the report to know how they did because you could just look at their stock. Their stock in pre-market is down 6% at the time of this recording. After they reported, they actually fell as much as 12% instantly because their forecast was so bad on the consumer. Newell Brands is a company that that owns brands like Rubbermaid or Crock-Pot. I mean, they got a ton of goods for babies and household goods and that. And you're seeing a massive slowdown, not only because of an inventory buildup. I mean, even Energizer Batteries was complaining that companies like Target and Walmart aren't buying as many new batteries because they're looking at all the shelves and trying to find where all the batteries are. And instead of having batteries on every damn aisle at Target and Walmart, they're starting to take the batteries and consolidate them to fewer places because they're just running through their inventory. They don't want to spend the money. They don't want to burn the cash on getting more inventory. You are also seeing a slowdown in warehouse construction because people are buying less junk and you have an inventory pileup not at warehouses, which is in-transit goods, but instead at actual stores. Amazon is now reportedly subleasing some of its warehouse space because of a slowdown in logistics and ordering. E-commerce software provider Inventory Planner says 50% of survey respondents from their survey are having trouble getting inventory even after post-Christmas and January discounting. 60% of companies that were surveyed by Inventory Planner say they are worried they need to liquidate excess stock, which means prices go down. Folks, if you watch my channel, I don't know how you could possibly make the argument that inflation is still going up, okay? Like, we've talked about wages on the path to plummeting. We've talked about goods and services on the path to plummeting. Yes, there are embers, but show me prices actually still going up somewhere other than lagging data. It's so freaking obvious, but whatever. I'll just keep pounding the table and people can do whatever they want. Anyway, baby and toddler retail sector. Most impacted by excess inventory, with 92% of respondents complaining about baby and toddler inventory. 55% complaining that luxury is getting hit. That's bad for Williams-Sonoma. 50% complaining that homeware and gardening is doing poorly. That's what we just saw with Newell Brands. 44% complaining about retail. And retailers are now having trouble projecting their required inventory because there's so much liquidating and so many price cuts going on that they're freaking out and they don't even know what the hell to do. Part of this could be because you're seeing people run out of money. And you see less borrowing, which is exactly what we've seen. You're also seeing substantially more price competition, right? Consider again, lower prices at Lyft, lower prices at Affirm. What's happening at Disney? Disney, every quarter, bragged about how per capita spend at the parks and cruise lines was going up. And they would give you a percentage. They would say, oh, it's up 50%. Oh, it's up 40%. They always gave you a percentage. This time, yeah, it went up. Yeah, probably because it only went up a few percentage points. You didn't actually give us the data point anymore. And in my opinion, when you read earnings calls, because this is what I do all day long, I think that's why you come here, to get a consolidated set of all the information. I read the earnings calls and I'm like, the stuff you're not saying anymore is generally a red flag. This is exactly what we've seen at many other companies before. Google is seeing their PP for ads fall. Almost every single advertising sector is seeing ads fall. Yahoo is laying off 50% of their ad business staff because the ad business is turning to crap. Amazon AWS complaining about falling PP. Unilever can't keep up with all of the increasing costs that they've had over the past year for commodities and other things that have sort of already been baked into inflation reports, but they can't raise prices anymore because people ain't buying anymore. The same exact thing is what we're seeing at companies across the United States. Look at Mattel. Down 12% on worse than expected toy sales, massive slowdown in toy sales. Even Enphase is going from massive quarter over quarter growth to potentially contraction in spending. That's why they got hit. Uber gave you the warning about Lyft. You have 34% more drivers at Uber. That's because people are going to work because they're out of freaking money. Now, Simon Property Group also complains about the same thing. Even though they're seeing positive rent spreads and renewals, they're seeing a lot of their customers complain about a softening economy and lower revenues. Now, keep in mind that when consumers spend less money, Simon Property Group makes less money because Simon Property Group actually takes a royalty fee off of the earnings of companies in their malls. That's a way of them basically being incentivized to actually keep the malls looking nice. Because if they don't keep the malls looking nice, then what happens? Well, then people don't come. And if people don't come, then the revenues in stores go down. So you kind of sort of like align incentives that way, right? But it's not just that. It's also that we are seeing a reduction in people's pent-up savings. And that's another potential issue. Now, JP Morgan thinks people aren't actually going to go through their post-pandemic savings until probably the second half of the year. But you're actually seeing more of a burn through, I think, than JP Morgan is projecting, happening based on articles like this. This is the Wall Street Journal. Households burn through pandemic savings. The cushions of savings many built up during the pandemic is thinning out. Americans have spent down about 35% of the excess savings they've accumulated as of mid-January, according to Goldman Sachs. By the end of this year, so they kind of align actually here with JPM, by the end of the year, forecasts estimate that pandemic savings will be roughly 65% gone. Today, some people are having to cut back on their spending or add to credit card balances, except we've already added so much to credit card balances at the end of last year that now even you're seeing credit card balances go down. The government's pause on student loan payments helps a little bit, but the point is, what are you seeing? You're seeing scaled back household spending. People are dining out less often. Actually, Chipotle having this is a little weird because it seems contradictory, but it basically aligns. When people dine out less often, they spend less money on food. Obviously, dining out is very expensive. But in addition to that, listen to this. Chipotle actually sees that wealthier people are coming in store more because they are downgrading from restaurants or from ordering at home. So they eat the crap they have at home because it's cheaper. The delivery fees are expensive, so they go into Chipotle, or they don't go to a restaurant and they go to like a Chipotle, which obviously a $14 burrito is less expensive than a $25 miso salmon at the Cheesecake Factory. And Chipotle can still sell you beer. So if you're into that, you can still go to Chipotle. Just make sure you wait at least 24 hours after having a beer before you drive, because obviously nobody in their right mind would ever have a single sip of alcohol and then drive. That's very bad. Never, ever drink and then drive. Very bad. Anyway, so look, the numbers here are very, very convincing. it's very obvious that people's disposable income is evaporating. It's very obvious that consumer spending is plummeting. But the decline of consumer spending leads to the decline of PP at many companies. And so your goal, in my opinion, as an investor, is trying to figure out, where do you invest? Do you just stay in cash? Where do you invest? In my opinion, you look for PP, massive PP, massive pricing power stocks. And in my opinion, where those pricing power stocks are is very simple. They're companies that can demand a high margin. That's important. I'm not necessarily saying prices don't come down, but they can demand a high margin even in the face of a recession. Those are companies you want to look for. Personally, I think that's mostly in the chip sector, away from memory. So you have to get away from memory and then look at the chip sector. Advanced microchips, 3 nanometers, 4 nanometers, 5 nanometers. Advanced chip makers, chip equipment manufacturers. Yes, Tesla's in there as well as a chip and robotics manufacturer, but also a company that has substantial margins in the auto industry. Apple has preservation of substantial margins, even though they too are starting to cut the price of iPhones in China because there's even a lack of PP in China. So folks, these are things to pay attention to. But in my opinion, you've got lots of deflation coming. This is not going to be a disinflation story in a few years anymore. I think you've got massive disinflation coming. At least that's what the data is saying now. Is it possible data starts coming in bad and maybe one day I'll actually wake up and read a single earnings call this quarter that says prices are going up, which I have not yet seen? Oh, damn. Then I'll tell you about it. But that's where I'm sitting right now. I think the consumer is screwed, and because the consumer is mostly screwed, prices gonna come down.